Welcome to the Deep Dive. We dig into the sources so you don't have to, pulling out the key insights you need, well, fast. Think of it as getting straight to the point.
And today, we're diving into where the financial markets might be heading. Our guide is a recent conversation featuring Alistair MacLeod.
Exactly, yeah, we've got this transcript from the Capital Cosm YouTube channel. It was recorded just a few days ago, May 19th, 2025.
And what really jumped out at us, the core theme, I guess, was MacLeod's concern, his growing concern about rising bond yields and, what that could mean for stocks. He even makes some pretty stark comparisons to 1929.
Okay, right. Let's unpack that.
Yeah.
Starting with the big worry, these rising bond yields. What does he see as the main drivers behind this?
Well, he flags two main things. First, there's this perception, an increasing perception, that holding U.S. dollars is getting riskier. Why? Because global trade might get disrupted, think tariffs, supply chain problems, that sort of thing. So if that happens, foreigners holding lots of dollars might think, maybe we don't need quite so many. Less trade, less need for the main trade currency, that could weaken demand for the dollar itself.
Right, that makes intuitive sense. Less global commerce, less need for the global currency. So what's the second driver he mentions?
The second one is really closely related. It's that foreign investors specifically see more risk in the dollar now. So if they're going to hold U.S. treasuries, which are denominated in dollars, they want a higher return to compensate for that extra risk, hence higher yields. It's just basic risk reward, really, from their perspective.
And he connects this to the idea of a debt trap. Can you explain that a bit more?
Yeah, sure. MacLeod's argument goes something like this. If the private sector's GDP growth, the productive part of the economy isn't keeping up with how fast government debt is growing.
Which he thinks is happening in the U.S. now, partly because of the big budget deficit.
Exactly. He estimates the deficit is around 7% of nominal GDP, which he believes could actually cause the private sector GDP to shrink by maybe 4 or 5%. So if that gap keeps widening, it gets progressively harder to actually finance the government's debt.
Okay.
Eventually, he warns, foreign investors might just become unwilling to buy U.S. government bonds. Doesn't matter what the yield is, they just won't buy. That's the trap.
Wow. He brought up a historical example too, didn't he? From the UK.
He did, yeah. The UK sterling crisis back in the mid-1970s. Back then, the British government had to offer, well, frankly, eye-watering yields on its bonds, its gilts. We're talking 15, maybe 15.5%.
15%.
Yeah, just to persuade people to buy them. MacLeod's suggesting that, look, if the U.S. keeps racking up debt without enough growth, we could potentially see something, maybe not that high, but certainly much higher yields than we're used to. It's a serious warning.
That really puts it in perspective. So where were U.S. yields sitting when this was recorded, May 19th?
Right, so the longer-term bonds, the U.S. Treasury 20-year and 30-year, their yields were getting close to 5%. He noted that's near 18 to 20-year highs. And the 30-year had actually just briefly poked above 5%.
And he saw warning signs elsewhere too. Japan, I think.
Yes, definitely. He pointed to Japan. Their longer-term government bonds, the 30 and 40-year ones, were seeing yields around 3%. Now, why is that a warning? Because Japan has this enormous government debt load, something like 260, 270% of GDP.
Huge.
And crucially, the Bank of Japan itself holds a massive chunk of that debt, maybe 60%. So rising yields there, even if they seem low compared to the U.S., are a big deal for such a heavily indebted country.
And the UK came up again briefly.
Yeah, just noting a similar upward trend in their long-term gilt yields, the 20, 30-year ones. But the fundamental point he kept making is that high government bond yields are just, bad news for stock valuations. Well, think about it. If you can get a decent, relatively safe return from a government bond, why take the extra risk of investing in stocks? It makes equities look less attractive by comparison, potentially causing investors to sell stocks and buy bonds, pushing stock prices down.
Okay, so that's the bond yield risk. Now, he also talked quite a bit about a credit bubble. What's his thinking there?
He starts with a pretty basic idea. Debt equals credit. They're just two sides of the same coin. And a lot of our current wealth, you could argue, is built on credit.
Okay.
But that's only sustainable if the debt underneath it all is sustainable. His argument is that we're in this pretty significant credit bubble, and it's starting to implode. These rising bond yields are part of that picture.
And he sees this bubble bursting, hitting the stock market.
Yes, he suggests that stock markets, especially in the U.S., might have already seen their highs, that the peak might be in as this credit starts to unwind.
Right. There was a listener question mentioned in the source. asking basically, if stocks and bonds aren't working, where does the money go? What did McLeod say?
Well, first he clarified something important. Bond yields are rising, yes, but that means bond prices are falling, so bonds aren't exactly getting a bid in terms of price.
Right, good point.
Addressing the question directly, he says the real problem is in the credit system itself. And if you want to escape a credit implosion, where do you go? You move into, well, real money, something without counterparty risk. For him, that's gold.
Interesting. And he thinks gold's recent run-up isn't just about gold itself, but more about currencies falling.
Exactly. His view is less that gold is soaring and more that currencies, particularly the dollar, are losing their purchasing power. It's the denominator weakening. He points to central banks, like the People's Bank of China, effectively swapping dollars for gold as evidence of this trend.
Okay, this is all sounding quite concerning. And then he brings in the 1929 comparison. What specific parallels does he draw? Obviously, things are very different now. Regulations, safety nets.
Right, and it's important to acknowledge those differences. But McLeod focuses on the dangerous mix. A bursting credit bubble happening at the same time as rising trade barriers, like tariffs. He sees that echoing the late 1920s credit boom, followed by the Smoot-Hawley tariff in 1930.
Yeah.
He even suggests today might be, potentially, more dangerous because we don't have the discipline of a gold standard anymore.
Can you just recap the scale of that 1929 crash you mentioned? It sounds terrifying.
It was absolutely devastating. The market dropped about 33% in the first 4 months or so. Then there was a rally, about 18%, which he calls a classic dead cat bounce.
Right.
But after that, it just cratered. Another decline of over 80%, leading to an overall loss on the S&P of nearly 90%. And 9,000 banks failed. It took until 1954, 25 years for the S&P just to get back to where it was before the crash.
Unbelievable. And gold.
Gold was fixed at $20.67 an ounce back then, right up until the government confiscated it in 1933. So, quite a contrast.
A very sobering precedent. Okay, let's switch gears to China. McLeod talked quite a bit about their gold and silver policies. What were the main points?
He really stressed China's long game with gold. It apparently goes back to 1983 when the People's Bank of China was specifically told to start accumulating it. Fast forward to 2002, and China becomes the world's biggest gold miner. He sees that as a very deliberate policy move.
And didn't they also change the rules for citizens around then?
Yeah, same year, 2002, they made it legal for private individuals in China to own gold. Before that, it wasn't generally allowed.
He linked this to Marxist theory somehow. That sounds interesting.
Yeah.
How did he explain that connection? Something about late-stage capitalism.
Yeah, it's quite a perspective. His interpretation is that, from the Chinese Communist Party's viewpoint, maybe capitalism is seen as a phase you go through to build up the industrial base, the means of production. Then, once that's built, call it late-stage capitalism, the state can effectively take control or ownership of that productive capacity. He suggests China's steady gold buying fits into this long-term, maybe ideological strategy, accumulating real assets.
What about silver? Did he touch on that?
He did. China's a big silver producer, too, and historically imported a lot, especially this raw form called d'or. He mentioned hearing from miners who sold their silver to Glencore, and there's speculation linking Glencore to JP Morgan, with the silver perhaps ending up in China. He even floated the idea that China might have been involved in keeping silver prices somewhat suppressed through these channels. But he also noted a possible shift starting around 2024, with silver exports from China maybe moving away from places like London and New York.
And does he see a strategic reason for their interest in both metals?
Oh, absolutely. He connects their interest in gold and silver, alongside their dominance in rare earth minerals, directly to their big strategic pushes, things like electrification, electric vehicles, and photovoltaic manufacturing, solar panels.
Right. Essential ingredients.
Exactly. These metals are critical inputs for the technologies China is betting on for its future economic and, frankly, technological power.
Okay, shifting again, what about Russia? McLeod offered some thoughts on their financial position, too.
Yeah, he pointed out Russia's quite significant gold reserves. The central bank holds maybe 2,000 tons, but he mentioned estimates that their sovereign wealth funds might hold another 10,000 tons. That's a lot of gold.
Wow.
Plus, they've ramped up their own gold mining, becoming, I think, joint second largest producer now. He also contrasted Russia with the West in some ways: relatively low government debt, less than 20% of GDP, he said, reasonable taxes. Now, inflation is high, around 8%, but he mentioned it's been accompanied by pretty significant wage growth, like 20–30% for people with jobs, and apparently banks are encouraging saving. His overall take seemed to be that Russia is in a relatively strong financial position, potentially even strong enough to move towards some kind of gold backing for their currency.
Interesting perspective. Lastly, he didn't mince words about Keynesian economics, did he?
No, definitely not. He was highly critical. He basically blames Keynesian theories and economists like Paul Krugman and Joseph Stiglitz, who promote them, for many of the economic problems we're seeing now. He went so far as to call macroeconomics itself a kind of non-science invented by Keynes. Quite a strong view.
Okay, so let's try and wrap this deep dive up. We've heard McLeod's concerns, serious concerns about rising bond yields threatening stocks, with some unsettling echoes of 1929.
Yeah, and his argument about a credit bubble starting to burst, the strategic importance of gold for countries like China and Russia looking for alternatives, and that pretty sharp critique of mainstream economics.
It feels like the central message coming through from this source is a potential shift in thinking maybe away from just accumulating wealth towards actively preserving it, given the landscape he describes.
Which really brings us to the final thought for you, the listener. Thinking about these dynamics, McLeod lays out the historical comparisons, the current market pressures, the potential fragility of credits. What strategies might you think about? How might you navigate this kind of environment to protect your own financial well-being?
It definitely gives you food for thought.
Yeah.
Maybe worth looking deeper into that relationship between bond yields and stocks, and perhaps brushing up on the history of financial crises. Understanding those forces seems pretty crucial right now.